Peter Lynch, one of the most legendary investors in Wall Street history, is famous for his remarkable ability to discover winning stocks before the rest of the market wakes up to their potential. During his 13-year leadership of the Fidelity Magellan Fund, Lynch achieved an average annual return of 29%, turning it into the world's best-performing mutual fund at the time. While many attribute this success to his philosophy of invest in what you know, there is another powerful analytical tool Lynch relied on that allowed him to separate attractive growth companies from overhyped disasters: the PEG ratio. PEG stands for price/earnings to growth, a metric designed to blend valuation with future expectations. While many investors stop at the PE ratio, assuming that a low PE means a cheap stock and a high PE means an expensive one, Lynch argued that valuation without growth is meaningless. A company might have a PE of 8 but no growth prospects, making it worse than a company with a PE of 30 growing earnings at 40% annually. Lynch believed, growth is what makes stocks worth owning. The PEG formula is straightforward: PEG equals PE ratio /earnings growth rate. The philosophy is just as simple: if the PEG is below 1, the stock may be undervalued relative to its growth rate. If the PEG is above 1.5 or 2, the investor should proceed with caution because expectations may be too high to sustain. Lynch often said that a PE of 20 is not expensive for a business growing earnings at 20% a year. In fact, that's fair value. But a PE of 20 on a business growing only 5% a year is extremely expensive, a time bomb waiting to explode in a portfolio. To truly understand why this matters, we must first look at what growth means. Every company falls somewhere on a spectrum: slow growth, average growth, fast growth, cyclicals, asset plays, or turnarounds. But for Lynch, fast-growing companies, the so-called growth stocks, are where fortunes are created. McDonald's, Coca-Cola, Walmart, and later Starbucks and Apple, these companies multiplied their earnings year after year. Their PE ratios were high at the beginning of their journeys, but investors who recognized their true growth potential didn't care. PEG allowed Lynch to find the balance between price and ambition. When a company has the power to double its business every few years, even a seemingly high share price can be a bargain. Conversely, a slow-growing company with a low PE can be a value trap, cheap for a reason and destined to stay that way. Lynch urged investors to search for companies in their everyday lives, but to verify growth with real numbers. A great product is only the start, the financials must support the narrative. PEG provided the proof. It allowed him to filter out emotional excitement and focus on rational potential. He was adamant that investors not rely on Wall Street analysts to calculate PEG for them. Analysts often use unrealistic future growth assumptions based on hype, not fundamentals. Lynch preferred a bottom-up approach: visit stores, talk to customers, observe product adoption, verify growth through the real economy. Then, and only then, plug numbers into the PEG formula. This boots-on-the-ground research was at the heart of Lynch's strategy. The PEG ratio was the mathematical confirmation of what he already suspected. When the growth trajectory matched the valuation, he bought aggressively. When it didn't, he moved on without hesitation. Lynch believed the stock market was often wrong in the short term but always right over time. Overhyping or underpricing a company can only last until earnings prove the truth. The PEG ratio, therefore, was not a perfect forecasting tool, but a compass pointing to where value and opportunity intersect. And the best thing about it? Anyone could use it. No advanced mathematics. No expensive research terminals. Just simple numbers and logical thinking. That's what Lynch admired: common sense investing powered by real knowledge. The story of PEG is the story of refining value investing for growth companies. It is the recognition that cheap stocks aren't always good and good stocks aren't always expensive. It trained investors to think deeper than surface-level ratios. And unlike many financial formulas that require pages of complex analysis, PEG fits on a napkin, yet has the power to change an investment portfolio forever. In the following parts, we will dive deeper into real-world examples, how market psychology can distort valuations, and how Lynch's formula remains a powerful weapon for modern investors navigating a market full of inflated hopes and hidden gems. PEG isn't just a ratio. It is a mindset, a framework for discovering the future's greatest companies before everyone else notices. To truly grasp the power of the PEG ratio, we must explore how Peter Lynch used it in practical investing, not as a theoretical academic metric, but as a tool for identifying explosive opportunities in the real world. Lynch always insisted on finding companies with understandable stories, simple business models, and real growth drivers that ordinary people could spot. PEG helped him quantify that story into an investment-worthy decision. Let's consider the typical investor mistake, chasing low PE stocks without considering growth. Imagine two companies. Company A has a PE of 8 but grows earnings at 2% a year. Company B has a PE of 28 but grows earnings at 40% a year. Many novice investors immediately choose Company A because it looks cheap. But Lynch would laugh at that assumption. He would calculate PEG. Company A PEG equals 8 divided by 2 is equal to 4, terrible. Company B PEG equals 28/40 is equal to 0.7, excellent. Lynch would take Company B every time. Why? Because while Company A may look cheap on the surface, its lack of growth means shareholder returns are likely stagnant too. Meanwhile, Company B is expanding rapidly, increasing both intrinsic value and future profits, making today's price irrelevant in the long run. Lynch believed that growth compounds wealth, and the PEG ratio exposed whether the market correctly priced that growth. However, PEG is not without nuance. Lynch cautioned investors, the PEG ratio is only as reliable as the growth estimate itself. Analysts love exaggerating forecasts to pump stocks. If a company claims to grow earnings at 50% a year for 10 years, Lynch would ask, is that realistic? Very few companies sustain lightning-fast growth forever. Eventually, competition arrives. Saturation slows expansion. Economic cycles fluctuate demand. And in some cases, companies cook the books. Therefore, Lynch applied PEG most effectively to companies he categorized as fast growers, typically businesses growing earnings between 20% and 50% annually, supported by real-world evidence such as expanding store counts, new product adoptions, or explosive demand trends. He avoided overly speculative tech startups unless they already demonstrated earnings momentum. His biggest winners came from retail and consumer-focused companies, places where average people's behavior gave early clues to growth. For Lynch, the PEG ratio always had to be combined with on-the-ground research, visit locations. Check product popularity. Study customer loyalty. If the company's growth story collapsed when examined in reality, PEG was useless. Another key insight Lynch provided is how PEG can reveal value traps, stocks that appear cheap only because their earnings are declining or stagnating. A low PE doesn't matter if growth evaporates. PEG exposes these traps quickly. Lynch also observed that investors often overpay for story stocks simply because the company seems futuristic or exciting. Biotech firms with no earnings. Early-stage tech companies burning cash, these firms cannot be evaluated using PEG because they lack profits, making them purely speculative. Lynch would rather buy a boring bakery chain earning money consistently than a hyped startup with no clear path to profitability. Market psychology plays a massive role in why PEG is so valuable. Investors panic and sell great companies temporarily facing setbacks. They get euphoric and overpay for companies enjoying short-term success. PEG puts sanity back into the process by forcing investors to ask, is growth worth the price I am paying? When enthusiasm clouds judgment, PEG is the wake-up call. When fear drives prices too low, PEG uncovers bargains. Lynch loved inefficiencies, markets misunderstanding growth stories. PEG was his method of quietly scooping up future winners while others argued over noisy headlines. The greatest takeaway from Lynch's application of PEG is this: you must think independently. Don't let market sentiment dictate your actions. Don't rely solely on traditional valuation metrics. Don't assume a stock is expensive just because its price has risen. PEG focuses on what truly matters: future earnings power. Those who understand that concept unlock the ability to identify the next Home Depot, the next Nvidia, the next Starbucks, before they become household names. PEG is the bridge between price and potential, the ultimate key to growth-driven wealth creation. In the final act of understanding Peter Lynch's PEG strategy, we explore its enduring relevance in a modern world of fast information, relentless media hype, and volatile markets. Many investors today think they are more sophisticated than those of Lynch's era. After all, we have artificial intelligence, algorithmic trading, massive data analytics, and 24/7 news coverage. But ironically, investors today make the same fundamental mistakes Lynch observed decades ago: chasing hype, ignoring earnings quality, and focusing on stock price instead of company performance. PEG remains a shield against those psychological traps. If investors had properly applied PEG to sectors like dot-com stocks, crypto blockchain hype businesses, or pandemic-fueled tech rockets, they would have quickly recognized plenty of stocks were priced for perfection with no real growth behind them. PEG would have screamed, warning, unsustainable valuations. Lynch emphasized that PEG works across all market types: bull markets, bear markets, or sideways markets, as long as earnings growth remains the core evaluation. The formula rewards disciplined thinkers and punishes gamblers. Today, the most successful growth investors, including those who rode the surges of companies like Tesla, Microsoft, Netflix, or Amazon, consciously or unconsciously apply Lynch's principle: price should always relate to growth. PEG shouldn't be used mechanically, though. There are sectors where earnings fluctuate wildly, like commodity producers, airlines, or cyclical manufacturers. In those cases, growth estimates can be unreliable. Lynch would avoid using PEG in industries dependent on unpredictable variables like commodity prices or government subsidies. Instead, he favored businesses with durable growth engines: consumer goods, regional retail expansions, service franchises, subscription models. Companies with repeat purchases and expanding customer bases create long-term earnings visibility, the perfect playground for PEG analysis. What makes PEG exceptional is how empowering it is for everyday investors. You don't need a fancy finance degree or Wall Street access. You need curiosity, observation, basic math, and independent thinking. Lynch wanted small investors to realize that they have advantages professionals lack: the ability to notice emerging trends before analysts do, spending time at malls, checking product popularity, and spotting what real customers love. PEG turns that real-world insight into informed investment conviction. It answers the most important question in growth investing: how much should I be willing to pay for a great company? Without PEG, investors fall into emotional traps: fear when prices fall, greed when prices rise. PEG restores rational judgment, a truth thermometer that exposes whether enthusiasm matches reality. Lynch's career is proof that simple ideas executed consistently lead to extraordinary results. PEG is not a secret. It's not complex. Yet, very few apply it correctly because it requires patience and discipline. And investors often lack both. But those who master PEG gain a lifetime advantage. As Lynch would say, the person that turns over the most rocks wins the game. PEG helps ensure that when you turn over a rock, you know exactly what treasure, or danger, lies beneath. Using PEG is not about predicting the future perfectly. It's about ensuring the price you pay today makes sense given the company's future capacity to earn more. That golden alignment is where multibagger fortunes are born. The ultimate lesson: the PEG ratio is not just a formula, it's a philosophy. A belief that growth matters. A commitment to think deeper than headlines. A refusal to pay too much for excitement or too little for a stagnant business. When you adopt PEG thinking, You begin investing like Peter Lynch, not chasing the market, but outsmarting it quietly, one smart decision at a time. And that is how ordinary people build extraordinary wealth through the power of intelligent growth investing. Thank you for joining us on this deep dive into Peter Lynch's powerful PEG investment strategy, a simple formula with extraordinary wealth-building potential. If you truly understand the relationship between price and growth, you are already on a smarter path than the majority of investors in the market today. Remember, great investing isn't about predicting the future perfectly, it's about making intelligent decisions based on real business performance. As Lynch proved, ordinary people, armed with the right knowledge and discipline, can achieve extraordinary results. If you enjoyed this video and want to continue learning the secret strategies of the world's greatest investors, make sure to subscribe, tap the notification bell, and like this video to support the channel. Your engagement helps us reach more aspiring investors just like you. Comment below with your thoughts or questions, we'd love to hear from you. Until next time, stay patient, stay curious, and keep investing with confidence. See you in the next episode.